Welcome back to APNA CAFE. Today we are diving into an essential topic in economics money and credit. Money and credit are the lifeblood of our economy, and understanding of the work is crucial. In this video, we will explore the fascinating world of money, its creation, and the role of credit in our lives. By the end of this chapter, you will have a solid grasp of these concepts and their significance in the world of finance. So let's get started. Okay. So first topic is money as a medium of exchange. Okay. So here money acts as an intermediate in the exchange process. It is called a medium of exchange. Okay. A person holding money can easily exchange it for any commodity or service that he or she might want. Means means here money acts an intermediate. What does it mean? Means if you want to buy something, like if you want to buy mobile, okay, for mobile you have to charge for it, okay, then what you will pay? You will pay for money, right? You will pay for money, you will pay money, then you will get that mobile, okay. So here money acts as an intermediate in the exchange process means if you want that money, you have to pay for it, and that is what money, okay. At the earlier time there was barter system, okay. So what is barter system? In barter system, where goods are directly exchanged without the use of money, okay. So that time, uh, uh, there was no money, okay. There that time, to buy something you have to exchange directly goods, okay. And that time was very difficult because let's assume a example, okay. If the shoemaker, okay, had to directly exchange shoes for a wheat without the use of money, he would have to look for a wheat growing farmer who not only wants to sell wheat but also wants to buy shoes in exchange, okay. That is both parties have to agree sell and buy each commodities, okay. So this is known as double coincidence of wants. What a person desires to sell is exactly want what the other wishes to buy, okay. So here you see that barter system and double coincidence of wants, right? So barter system means directly exchange of goods, but double coincidence of wants where both parties have to agree to sell and buy each other's commodity, okay. That is called double coincidence of wants, okay. Now next topic is modern forms of money. In the early ages, Indians used grains and cattle as money. Okay. Thereafter came the use of metallic coins, gold, silver, copper coins, a phase which continued well into the last century. Now, the modern forms of money include currency, that is, paper notes and coins. Okay, the modern forms of money, currency, and deposits are closely linked to the working of modern banking system. So, further, we will understand that what is currency and deposits. Okay, so of course, we know that paper notes and coins, which we use to buy something for service, okay, we use all these things, right? So let's know what is currency. In India, the Reserve Bank of India issues currency notes on behalf of the central government, okay. No other individual or no other organization is allowed to issue currency. The rupee is widely accepted as a medium of exchange in India, right? Okay. Now we will know deposits in banks. Okay, the other form in which people hold money is as deposits with banks. People deposit their extra cash with the banks by opening a bank account in their name. Banks accept the deposits and also pay an amount as interest on the deposits. The deposit in the bank accounts can be withdrawn on demand. These deposits are called demand deposits. The payment are made by check instead of cash. Okay, so here we understand demand deposits. Okay, what is demand deposit? Means, if let's assume our parents, okay, parents earn money, okay, so they don't hold all this money at their home, right? They keep some amount, a major amount of their money in the bank, right? So they they keep their money in the bank, and whenever required, then they can go the bank and withdraw the demand the money and withdraw the money. Okay, so this process, this deposit, whenever you want to demand, whenever you have the requirement of money, you can go to the bank and demand for the money, and you can withdraw the money. Okay, so this is known as demand deposits. Okay, now the next one is check. Okay, so what is check? A check is a paper instructing the bank to pay a specific amount for the person's account to person in whose name the check has been issued. Okay, so here you can see the check. Okay, Mr. Saim, it is the check of Mr. Saim who has transferred 57,000 rupees to Prem Kumar. Okay, so this check is prepared for Prem Kumar. Here you can see a number of codes. Here account number, bank branch code, check number, coding used by banks, right? So this is check, and here you can say date. Okay, now we will see loan activities of banks. Okay, so banks keep only a small proportion of their deposits as cash with themselves, right? These days, banks in India hold about 15% of their deposit cash. This is kept as a provision to pay the depositors who might come to withdraw money from the bank on an on any given day. Okay, so there a lot of persons come to bank, right? A lot of money also deposit there. Then the bank don't keep all this money uh, in their bank. Okay, a small portion of the money they keep of themselves, because means they keep only 15% of deposit as a cash, because banks use the major portion of the deposit to extend loans. Okay, there is a huge demand for loans for various economic activities like farming, for startup of anything, right? Banks charge a higher interest on loans than what they offer on deposits. Okay, like here you can see that depositors and borrowers. Okay, so here you are saying that depositors and borrowers, people make deposit, people take loans. Okay, people make withdrawals and get interest, right? And people repay loans with interest. Here people deposit their money and they get what? Interest, but they get a lesser amount of interest. Okay, and here who borrows the money, then they repay loans with their interest, but their interest rate is always higher than the interest rate of depositor. Okay, so the difference between, okay, let's assume depositors deposit 100 rupees, okay, and they are getting 2 rupees of interest. Okay, and borrowers borrow 100 rupees and they are paying interest of 5 rupees. Okay, so the difference here, we will understand the next step, that is the difference between what is charged by borrowers and what is paid to depositors is their main source of income for banks. So the difference, what is the difference? The depositors getting 2 rupees of interest, and the bank getting 5 rupees of interest. Okay, 5 minus 2 and means 3 rupees. Here the 3 rupees is income for banks, the source of income for banks. Okay, so that's it for today. Okay, we have understand what is money, and modern forms of money, and about banks, currency, deposit, demand deposit. Okay, and the loan activities of banks. That is for today. Thank you. Further, we will in the next video we will understand uh, the further topics. Okay, thank you.